时要给的，就是他让我 replace 那些。
Testing, testing.
So Martinez, how was
great. The Chinese.
Good evening, everybody. It's a pleasure to welcome you at this press conference following the 25th EU-China Summit. President of the European Council, Antonio Costa, and the President of the European Commission, Ursula von der Leyen, will brief you on the meetings they had with President Xi and Premier Li. And without further delay, I'll give the floor to President Costa.
Good evening, Ursula. We have just concluded the 25th European Union-China Summit. I would like to thank President Xi and Prime Minister Li for hosting us today and for the open and frank exchanges that we had. This EU-China Summit takes place on the 50th anniversary of our diplomatic relations. This anniversary is an opportunity to reflect on our shared story and to look towards the future. Over the past 5 decades, European Union and China relations have evolved greatly. The European Union remains committed to deepening our bilateral partnership, making concrete progress in addressing concerns with respect, goodwill, and honesty. We have become key trading partners and developed a wide-ranging, rich and deep cooperation. The European Union and China are major economies and global powers. How we engage and cooperate matters to the world. The European Union and China have a shared interest in pursuing a constructive, stable, balanced, and mutually beneficial relationship. We want to work together on global peace and security, prosperity, and sustainable development. As such, tackling the global challenge of climate change is shared priority. Today, we discussed with President Xi and Premier Li ways to further expand and deepen our long-standing engagement, both bilaterally and as responsible leaders at the global level. We agreed that the European Union and China have a joint responsibility to uphold the Paris Agreement. And I'm very pleased that for today's summit, we have managed to agree on a substantive joint statement on our cooperation in the climate field. This sends an important message on our work together. And we encourage China to also propose an ambitious national determined contribution for COP30, and China should lead by example in line with its major global role. We agreed that we have a shared responsibility to support multilateralism and the rules-based international order, and to uphold the principles enshrined in the United Nations Charter. As a permanent member of the United Nations Security Council, China has a key role and responsibility on this. In this context, we address Russia's war of aggression against Ukraine. The war in Ukraine goes far beyond Europe. It is a conflict with global implications that undermines the rules-based international order and is not just a European conflict. And we agreed on the need to achieve a just and lasting peace as soon as possible. Today's discussion was one of great sincerity. This discussion must continue even if we don't agree on certain issues. Promoting and protecting human rights is a central pillar of the European Union's engagement with other countries, including with China. We welcome the recent round of the European Union-China Human Rights Dialogue that took place in Brussels in June. Today, we reiterated our concerns, and we will continue engaging on this important topic. Last but not least, an important part of our agenda concerns our trade and economic relations. The European Union and China together account over a third of global GDP. So having a fair balance in our economic relation is essential. We discussed trade distortions, imbalances, and market access issues, with one clear message as a bottom line. A fair and mutually beneficial trade relations are possible and should be our joint aim. Together with President von der Leyen and the High Representative, I came to Beijing to address all these issues directly with China's President Xi and Premier Li. The European Union always prioritizes open and constructive dialogue to find shared solutions. Dialogue and negotiation are in our DNA. That's what we did today in an open and frank manner. Now, it is time to put today's discussion into action and to make further progress. Thank you.
Thank you very much, Antonio. Europe and China are indeed two of the world's three largest economic and trading powers. And this makes our relationship one of the most consequential of the 21st century. From the outset, Europe's approach has been clear, consistent, and result-driven. We are defending our interests. We are carefully implementing a de-risking strategy, and we are strengthening our economic security and our competitiveness. Meanwhile, we remain committed to frank, respectful, and open dialogue with China, and today's summit provided exactly that. It was a valuable opportunity to work towards concrete progress in key areas of our bilateral relations, but we also clearly explained our concerns with the Chinese leadership, particularly in trade and investment. And let me start with this. A few figures. Today, the European Union accounts for an impressive 14.5% of China's total exports. Yet China only represents 8% of our exports. These numbers speak to the scale of our relationship, but they also expose a growing imbalance. It is mostly due to an increasing number of trade distortions and market access barriers. But unlike other major markets, Europe keeps its market open to Chinese goods. This reflects our long-standing commitment to rules-based trade. However, this openness is not matched by China. The European Union's trade deficit with China has doubled in the last more than 300 billion euros by now. So we have reached a clear inflection point. As we said to the Chinese leadership, for trade to remain mutual, beneficial, it must become more balanced. Europe welcomes competition, we like competition, but competition has to be fair. So we raised three priority areas where we believe progress is both possible and needed. The first is market access. Reciprocity is a simple and clear principle in this regard. At our summit, I referred to the importance of reciprocity in the public procurement, and today we agreed to work on concrete solutions for that. Second, we discussed at length the issue of overcapacity in China's economy in all the crucial sectors like, for example, steel, solar panels, electric vehicles, batteries, and others. The subsidized production does not match the domestic demand in China, and therefore overcapacity produced here time when we are making significant investments, for example, in clean energy transition. The Chinese leadership has started to look into this issue under the term involution and expressed willingness to support more the consumption and less the production part. This is important. We need to see progress on this issue. The production part, this is important. We need to see progress on this issue because without progress it would be very difficult for the European Union to maintain its current level of openness. The third issue we raised was export controls on rare earth and permanent magnets from China. As you know, these export controls have placed significant strain on some European companies. To keep trust in our trade relationship, we need reliable and secure supply of critical raw materials from China. Being seen as a reliable supplier and partner is clearly aligned with China's long-term economic and strategic interests. So we acknowledge China's efforts on fast-tracking licenses for the critical raw materials, and we agreed, and this is new, to have an upgraded export supply mechanism. In other words, if there are bottlenecks, this upgraded supply chain support mechanism can immediately check and solve the problem or the issue that is out there. The need to rebalance our relationship is even more urgent in today's context of the global rise of tariffs. As two of the world's largest economies, the European Union and China share a responsibility to uphold and reform the global trading system so we can keep it open, fair, and grounded on rules. This responsibility also extends to upholding international norms, rules, and institutions. And this is why we raised the critical issue of China's support for Russia's war of aggression against Ukraine. This has a direct and dangerous impact on Europe's security. And we expressed together our expectations that China would follow up on our concerns and the expectation that it would use its influence to bring Russia to accept a ceasefire, to come to the negotiation table, enter peace talks, and put an end to the bloodshed. How China continues to interact with Putin's war will be a determining factor for our relations going forward. Finally, we discussed climate change. Our joint statement on climate and the environment is a big step forward. We both see the opportunities to work closer together in sectors such as emission trading, just introduced here in China, carbon capture and storage, the circular economy, and our cooperation can set a global benchmark. Together, the European Union and China must uphold the Paris Agreement now more than ever. The European Union is doing its fair share. China's climate ambition matters immensely. We are both convinced that the triple planetary crisis of climate, biodiversity loss, and pollution requires a strong multilateral framework, and we both want COP30 in Belém to deliver ambitious results. From the summit, I gather that there is a lot we can do together. Despite our difference, and we have differences, we can find pragmatic solutions. Europe will always defend its interests, as China would. We are ready to enhance bilateral cooperation and build a more balanced and more stable relationship. We know the next 50 years of EU-China relations will be shaped by the choices we make today. Thank you.
Thank you very much. I'll open the floor for questions. Please note that there's interpretation provided in English and in Chinese. I'll start with the paper.
Thank you. Good evening, President. Question from the paper. And we all know that there are many differences between China and the EU. We have different social system, different culture and history, and also we have some different views on some bilateral and international issues. So my question is, as we mark our 50th anniversary, how can we keep this divergence from our cooperation and communication in the future? Thank you.
Well, by dialogue. First of all, we respect, of course, the difference of the systems, but by dialogue is the only way to ensure mutual understanding, to identify problems, and to address these problems to find solutions, and also to work together in spite of this difference in the matters that we need to work together because they are global challenges and the world needs a close cooperation between the European Union and China. And that's the reason because we are here. We have been here doing this along of this day, working with President Xi, working with Prime Minister Li, and now I think we have a clear work to develop together.
Yeah, indeed. This is a relationship that is as important as it is complex, without any question, and therefore openness, frankness, mutual understanding, so listening to each other, must be the foundation of our discourse, our dialogue. And I think the summit delivered exactly on that one. We have very frankly and openly raised our concerns, very clearly, very direct. You know, the trade and investment and geopolitical issues that we mentioned. We have partially identified solutions. I mentioned the mechanism, if there are bottlenecks in the export controls, that we have a swift solution for that one, for example. And of course, we also recognize that we have shared challenges or concerns where together we can make a big difference. And this is, for example, the fight against climate change or protecting the environment, but also humanitarian needs, development aid, and topics like this. So it was full of different topics, was a day, but very constructive and very pragmatic.
Thank you. I'll give the question to Reuters. Microphone, please.
Sorry. How close is the EU to a trade deal with the US, and what are the key sticking points, and what concessions is the EU willing to offer President Trump? And lastly, how has the potential EU-US trade deal affected the dynamic of today's summit discussions? Do you think that's changed the way the Chinese have approached Europeans? Thank you.
So, during all these weeks, our primary focus is on achieving a negotiated solution. We want a negotiated solution. We have at the moment very intense technical and political contacts and discussions that are ongoing. But we are very clear, since weeks also, why we want a negotiated solution. All other instruments are on the table and remain on the table till we have a satisfactory result. Now to the second part of your question, our relationship with China is of importance, but it stands on its own merits. That's also very important. It's independent of the actions or the issues we have with others. And I think what we just referred to, what we discussed during the summit, speaks for itself, underscores a shared responsibility that we have, but also the differences that we have to tackle.
Thank you. I will give a question to Phoenix.
Thank you. With Phoenix TV, I want to raise a question to President von der Leyen. You said in your meeting with President Xi that EU-China ties are at inflection point, and you raised concerns from the EU side. But my question is, what is that the EU is willing to do to really maintain this relationship stable and sustainable? Thank you.
Yeah, indeed. I used the term that we are at an inflection point. It is an important relationship that we have, but to be successful, we need to see more progress on the issues that are challenging for us. So important is to listen to each other and to find pragmatic solutions. And you might know that we have several high-level dialogues. We have the very successful high-level dialogue on climate and environment. It took place, I think, a week or 10 days ago with the good result of the joint statement. We have a very important high-level dialogue on the economy and trade. The issues I was mentioning in my statement are very dominant there. Important on human rights. And we launched today, as I said, the new export supply mechanism that looks at export controls and makes sure that there are no bottlenecks, no slowing down the process of delivering critical raw materials that are under the export controls to the companies that need it. So very pragmatic, but it's important to listen to each other because then you can often dissolve prejudices. You can find where the issue is really painful and where you have to find a solution, and then you have a pragmatic approach to the whole topic.
Thank you. Next to El País.
Thank you for the opportunity. I would like to know on Ukraine, the topic of Ukraine. So, I mean, we come from some tough weeks in this respect, with reports published on Wang Yi expressing in his visit to the EU this idea of China not interested in the end of the war, and of course the recent sanctions package. And you've expressed that you told the Chinese side your concerns. I would like to know, did you receive any new commitments from the Chinese side, or did they reckon anything new? Did they understand your points? Thank you.
But first of all, we share with China two important points. First of all, the European Union and China, we uphold the United Nations Charter, and namely the values of sovereignty, territorial integrity, and respect of the international recognized borders. And several times, China expressed the same position about this war in the United Nations, and recently voted the resolution presented by several member states of the European Union in the General Assembly. Second, we expressed the same wish to reach a just and lasting peace as soon as possible. And we had the opportunity to express, first, our conviction that China, as a permanent member of the Security Council, has a special responsibility to influence Russia to stop this war, to accept an unconditional ceasefire, and to go to a fair negotiation with Ukraine. And of course, we also stress that in war times, dual-use goods often are used as enablers of the war. And for this reason, we ask Russia to pay attention of their exports to Russia to avoid the use of dual goods for war purposes.
Yeah, indeed. We have been very clear on that topic. China has an influence on Russia, like the European Union has an influence on Ukraine, and that it is our expectation that China uses this influence to make sure that Russia is coming seriously to the negotiation table. Like we in the European Union don't even have to use our influence because President Zelensky has already offered and is at the negotiation tables and offered to sit down and negotiate seriously with Russia. In those negotiations then, I fully acknowledge that two sovereign countries decide on what they want to discuss and how they want to discuss and what the outcome in the very end is. But important is that we have a ceasefire and that the negotiations at the table take place. There is a true and genuine willingness to find a solution and to end the bloodshed.
Thank you. We will take one final question from APT.
Thank you. My question from AFP is European leadership talks about balancing its trade relationship with China, but there have been no signs of a shrinking deficit, with European markets heavily dependent on imports from China.
I haven't understood. Sorry, but
Can you repeat the question, please?
Sure. My question is that European leadership talks about balancing its trade relationship with China, but there have been no signs of a shrinking deficit, with European markets still heavily dependent on China for materials in technology and energy and other manufacturing components, while also lobbying for these loosened export restrictions on rare earths. So what are some practical steps that the EU plans to take to address the $360 billion trade deficit with China, and can you provide any glimpse into the time frame of that? Thank you.
So we had today a very interesting business community meeting, Chinese businesses and European businesses, and there was also very clear that it is three main issues that are restricting the potential that could be possible in trade between the European Union and China, and this is the lack of market access, the tariff barriers partially, but also the non-tariff barriers. For example, the Buy China principle is often used by local authorities not to allow European companies to compete on a fair level playing field. So market access is one big topic. The second topic is indeed the export controls, or let's say the reliability of supply chains. And here the reliability of supply chains is very much focused on the topic of critical raw materials, permanent magnets, rare earths, for example. Here, I think the summit showed that we can find practical solution, that there will be more transparency about the speed of allowing the export license to function, more speed in delivering on these critical raw materials to the companies. And if there is a delay, a critical delay, we have now established a mechanism where the companies can immediately ask us to mediate and to find out why there's a delay on the delivery of the critical raw materials to the companies. So a very pragmatic step forward in one of the major topics the companies in the European Union are complaining about. And as I said, if it comes to the Chinese market, it's mostly the access to the market that is demanded.
That's it for tonight. Thank you for attending this press conference.
Good afternoon and welcome to our press conference with President Lagarde and Vice President de Guindos. And my name is Wolfgang Preußel. As always, we are joined by journalists who are connected via video link. If they ask questions, please turn on the camera and the microphone. And with that, I hand over to President Lagarde, please.
Thank you very much, Wolfgang, and good day to all of you. The President, the Vice President and myself welcome you to our press conference. The Governing Council today decided to keep the three key ECB interest rates unchanged. Inflation is currently at our 2% medium-term target. The incoming information is broadly in line with our previous assessment of the inflation outlook. Domestic pressures have continued to ease, with wages growing more slowly. Partly reflecting our past interest rate cuts, the economy has so far proven resilient overall in a challenging global environment. At the same time, the environment remains exceptionally uncertain, especially because of trade disputes. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release available on our website. And I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. In the first quarter, the economy grew more strongly than expected. This was partly because firms front-loaded exports ahead of expected tariff hikes. But growth was also bolstered by stronger private consumption and investment. Recent surveys point to an overall modest expansion in both the manufacturing and services sector. At the same time, higher actual and expected tariffs, the stronger euro, and persistent geopolitical uncertainty are making firms more hesitant to invest. The robust labor market, rising real incomes, and solid private sector balance sheets continue to support consumption. Unemployment stood at 6.3% in May, close to its lowest level since the introduction of the euro. Easier financing conditions are underpinning domestic demand, including in the housing market. Over time, higher public investment in defense and infrastructure should also support growth. More than ever, the Governing Council considers it crucial to urgently strengthen the euro area and its economy in the present geopolitical environment. Fiscal and structural policies should make the economy more productive, competitive, and resilient. Governments should prioritize growth-enhancing structural reforms and strategic investment while ensuring sustainable public finances. It is important to complete the Savings and Investments Union and the Banking Union following a clear and ambitious timetable, and to rapidly establish the legislative framework for the potential introduction of the digital euro. The Governing Council welcomes the Eurogroup's commitment to improve the effectiveness, quality, and composition of public spending, and supports the efforts by European authorities to preserve the mutual benefits of global trade. Annual inflation stood at 2% in June, after 1.9% in May. Energy prices went up in June, but are still lower than a year ago. Food price inflation eased slightly to 3.1%. Goods inflation edged down to 0.5% in June, whereas services inflation ticked up to 3.3% from 3.2% in May. Indicators of underlying inflation are overall consistent with our 2% medium-term target. Labour costs have continued to moderate. Year-on-year growth in compensation per employee slowed to 3.8% in the first quarter, down from 4.1% in the previous quarter. Combined with stronger productivity growth, this led to slower growth in unit labour costs. Forward-looking indicators, including the ECB's wage tracker and surveys on wage expectations of firms, consumers, and professional forecasters, point to a further decline in wage growth. Short-term consumer inflation expectations declined in both May and June, reversing the uptick observed in previous months. Most measures of longer-term inflation expectations continue to stand at around 2%, supporting the stabilization of inflation around our target. Turning now to the risk assessment. Risks to economic growth remain tilted to the downside. Among the main risks are further escalation in global trade tensions and associated uncertainties, which could dampen exports and drag down investment and consumption. A deterioration in financial market sentiment could lead to tighter financing conditions and greater risk aversions, and make firms and households less willing to invest and consume. Geopolitical tensions, such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, remain a major source of uncertainty. By contrast, if trade and geopolitical tensions were resolved swiftly, this could lift sentiment and spur activity. Higher defense and infrastructure spending, together with productivity-enhancing reforms, would add to growth. An improvement in business confidence would also stimulate private investment. The outlook for inflation is more uncertain than usual as a result of the volatile global trade policy environment. A stronger euro could bring inflation down further than expected. Moreover, inflation could turn out to be lower if higher tariffs lead to lower demand for euro area exports and induce countries with overcapacity to reroute their exports to the euro area. Trade tensions could lead to greater volatility and risk aversion in financial markets, which would weigh on domestic demand and would thereby also lower inflation. But by contrast, inflation could turn out to be higher if a fragmentation of global supply chains pushed up import prices and added to capacity constraints in a domestic economy. A boost in defense and infrastructure spending could also raise inflation over the medium term. Extreme weather events and the unfolding of climate crisis more broadly could drive up food prices by more than expected. So looking at the financial and monetary conditions now. Market interest rates have increased since our last meeting, especially at longer maturities. At the same time, our past interest rate cuts continue to make corporate borrowing less expensive. The average interest rate on new loans to firms declined to 3.7% in May from 3.8% in April. The cost of issuing market-based debt also came down, falling to 3.6% in May. While the growth rate of loans to firms moderated to 2.5% in May, corporate bond issuance was stronger, growing at a rate of 3.4% in annual terms. Credit standards for business loans were broadly unchanged in the second quarter, as reported in our latest bank lending survey for the euro area. While banks' concerns about the economic risks faced by their customers had a tightening impact on credit standards, this was broadly offset by stronger competition among lenders. Meanwhile, firms' demand for credit increased slightly, benefiting from lower interest rates, but they remained cautious because of global uncertainty and trade tensions. The average interest rate on new mortgages has barely changed since the start of the year and stood at 3.3% in May. Growth in mortgage lending edged up to 2% in May in the context of a strong increase in demand, while credit standards tightened slightly in the second quarter. So in conclusion, the Governing Council today decided to keep the three key ECB interest rates unchanged. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. And in any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions.
And the first question goes to Annette Weisbach of CNBC. Annette, please.
President Lagarde, thank you for taking my question. The first one is on the euro exchange rate. So we've heard from your dear colleague, the Vice President Luis de Guindos in Sintra, that anything beyond 120 might be complicated. So what's your assessment? When does it start to get complicated, and when do the deflationary effects from that higher euro do start to worry you? Second question is on the tariffs. If we were to get that 15% trade deal with the United States, is that according to your baseline, and would that lift the uncertainties in a way which is good enough for the euro area to grow? Thank you.
Thank you very much for your twofold questions. Let me just tell you that in relation to exchange rate, we do not target any exchange rate. Second, we monitor exchange rate indeed, because exchange rate matter for our inflation forecast. And I'm here quoting my dear friend, colleague, Vice President, who said recently, we take into account exchange rate to forecast inflation. We are exactly on the same page in terms of our message regarding exchange rate. Your second question had to do with conjecture as to what will be the outcome of ongoing trade negotiations. And I know that there was a newspaper yesterday who sort of hinted that we were at a particular closure. It was a closing in, not a closure, right? And required very careful reading. We are attentive to where the negotiations are heading. We are not in a negotiating position. We are operating on the basis of the work that we do to forecast, to anticipate. We have a baseline on which we are basing our decision of today, which is our June baseline, which holds. You know, that baseline is generally confirmed by all the recent data that we have received. But we take things one day at a time. We decide meeting by meeting, But we take news one day at a time, and for the moment we are relying on our baseline, relying on the scenario that we have done back in June, which we have published, which you all have had a chance to look at, and that's what it is. But one thing I will add to that is that the sooner this trade uncertainty is resolved, so I think we use the word resolved swiftly, so the sooner it is resolved, the less uncertainty we will have to deal with, and that would be welcome by any economic actors, including ourselves. Thank you.
Next question goes to Alex Weber of Bloomberg. Alex, please.
Good afternoon. Thank you very much. I've got two questions on your statement. So you highlight the resilience of the economy so far. Does this resilience reduce the need to deliver another rate cut in the autumn, even if this was part of the baseline scenario in June? And the other question is on your reaction function. So you added that future decisions will also be based on the risks surrounding the inflation outlook. Could you just explain why this addition was necessary? Thank you.
Sure. Thank you very much. And thank you for noticing the addition. You're right. So I'll start with that one. As you know, we concluded our strategy assessment. We had a strategy review that we concluded in 21. We had committed to review that strategy on the basis of new economic development and certainly in view of the process through which we had gone, namely facing those incredible shocks and going full cycle in many ways. So we did that, and as a result of that strategy assessment, it was determined that we had to amplify, enhance, and probably give a slightly higher focus to risk assessment. And obviously scenarios, sensitivity analysis are part of that exercise that is conducted on a regular basis, that is published occasionally, but conducted on a regular basis. But it is certainly very opportune that this focus on enhanced risk assessment is agreed at a time when we have a higher level of uncertainty. So that's the reason why it is. You have the usual risk assessment section in our monetary policy statement, which focuses on growth and inflation. And we thought it was appropriate, given the enhanced focus that we want to give to the measurement of risk, the assessment of risk, to have actually that element included in the first part of our monetary policy statement. You know, we are, I'm going to repeat myself, we are in a good place. And we are in a good place because inflation is at 2%, but we're not focused on data points. We're looking at all sorts of data, and our target is the medium-term inflation, which is at 2%. So I'm saying that we are in a good place because our projections point to inflation stabilizing at target in the medium term. As you will remember, I have often mentioned the importance of wages. Wages are heading in the right direction and are showing this downward trend that we were expecting. The unit profit is continuing to buffer in a little bit of that wage increase, which is the natural result of an element of catching up and adjusting to the development of the economy. And we have seen, and I'm coming now to the specific point of your question, we have seen growth developing in a relatively favorable way. Of course, if you look at Q1 in particular, we will have Q2 in a week's time. But if we look at the numbers we have, Q1 was a surprising 0.6%. Now, of course, because we like to look under the hood, 0.6% is partly attributable to Ireland. And then if you look at what was actually driving this growth increase, it's partly front-loading because economic operators anticipated the rising of tariffs and decided to front-load. But it's not just front-loading. It's also increased consumption an increased investment, and not only attributable to Ireland, which is often an outlier for all sorts of intellectual property reasons and what have you. But so growth is developing mostly, if not a little better than in line with our expectations. So we are looking at development. As I said, last time around, we are now confident that the inflationary shock of the past few years is now behind us. And our job now is to look at what's coming and to try to, first of all, wait, because there is a lot of elements that will pan out in the next few months, and see what impact it will have on our economy. Thank you.
And the next question goes to Balázs Korányi of Reuters. Balázs, please.
Good afternoon. Thank you for taking my questions. Two, of course. The first is about the risk of undershooting the target. Talking to some of your colleagues and reading more economist notes, it seems to me that there is a greater discussion about undershooting. In your discussion today, was there anything about this? Do you think over the last 6 weeks, the risk of below target inflation has increased? The other question is about the scenarios you published 6 weeks ago, and especially the more severe outcomes, which seem to suggest that even in case of retaliation, the whole package would be disinflationary. Now, I'm curious, is there consensus in the Governing Council about this, or is there perhaps still a discussion that such a scenario could turn out to be inflationary rather than disinflationary?
Well, thank you for your two questions. Concerning the risk of undershooting, I just want to remind you and colleagues that we are at 2% latest reading, but more importantly, because that's what we have to look at, we are at 2%, which is our medium-term target. So is there a risk of undershooting? There is actually a forecast of undershooting in 26 for all sorts of base effects reasons and consequences that we are forecasting today. But as has been mentioned by some of my colleagues in their various speeches, we are not going to be moved away by some minor deviation. And we are looking at the medium-term targets that we have. And we will proceed on the basis of that 3 elements to determine our monetary policy stance. So that is the result of our strategic assessment, but it's also the approach that we are taking inside the Governing Council. Now, you will always find 2 or 3 governors who are very concerned about the undershooting. But what I say to you is undershooting is actually in our projection, in the staff projection. It's there. But what matters is our medium-term target, because this is the objective that we have reaffirmed in our strategy, and which is definitely 2%. And when I look at my inflation expectations, it is strongly anchored around 2% in the short term, but also in the longer term. So that's as far as undershooting is concerned. Now, we have conducted that exercise with our scenario, and as you know, we have this sort of rosy scenario where everything is at 0, it's perfectly symmetric and reciprocated. We have the baseline, which is at 10%, which is the current rate that the economy is taking in, and we have the 20%, which is the severe scenario. Some of those scenarios have retaliation measures, not all. And I think that as we observe the interesting negotiations and what leaks out in various form, retaliation is optional, doesn't seem to be a definite element. But the ultimate net-off result in terms of inflationary forces or disinflationary forces cannot be determined at this point in time. Why is that? Because it's a very complicated set of factors that we will have to analyze, take into account to determine what the impact will be. We currently have a list of different rates. You have the hypothetical 10 or 15 or X%. We have some sectoral rates as well that apply to either the automotive industry or the steel and aluminium industry, a big question mark on pharmaceutical. And to add to that complexity, you also have the indirect impact on our economy of tariffs that are decided in relation to other countries that will induce some redirecting or rerouting, which themselves will have an impact on our economy. For the moment, we assume that this impact will be inflationary, and staff has worked on that. But equally, and this is very difficult to assess for the moment, there will probably be some bottlenecks issues as a result of the trade disruption. There will probably be, just as there will be some rerouting and redirecting, there will be some supply chain significant changes. And that will have also an impact on inflation, more likely to be inflationary than disinflationary. So it's not just, trade one way, retaliation in response, but it's also the rerouting, the redirecting, the supply chain disruption, the bottlenecks that will all come together to impact prices. Now, the next question you have to ask yourself as well, and that we are asking ourselves and will be asking, is that going to be a level effect? Is that going to be an ongoing consequence of a new paradigm? There is a lot of uncertainty out there. We are mindful of all that. We are going to monitor, factor in, model as much as we can. But at this point in time, conclusion is not, in my view, definite as to which of those forces will prevail.
Next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you for taking my question. Good afternoon. My first question is on tariffs and interest rates, in the sense that the Federal Reserve would have cut interest rates if it weren't for tariffs, and Chair Powell said in Sintra, we went on hold for tariffs. Can you explain how far is the ECB today on hold because of tariffs? And my second question there again has got to do with the United States again, because Donald Trump called the signing into law of the Genius Act on US dollar-backed payment stablecoins a giant step to cement American dominance of global finance, the greatest revolution in financial technology, and secures the dollar status. But on monetary policy, there is a concern that the growth of stablecoins for trillions would have an impact on the short-term rates in the United States because of how much T-bills is going to be used as a back to the stable coins. So there is a big debate on impact of this on monetary policy, on central banks, and I wonder if you can say, if you share these concerns of these innovations on monetary policy tools. Thank you.
Well, thank you for your two questions. I think it's a good expression that my colleague and friend and esteemed central banker has used to refer to being on hold. So we ourselves at the ECB, we have left our rates unchanged, and you could argue that we are on hold. We are in this wait and watch situation, and any monetary policy decision will, for the future, be decided on the basis of data, will be decided meeting by meeting, is not predetermined by any particular path. And I think that the jury is out as to how quickly the uncertainty will be cleared under present circumstances. So a large part of that uncertainty is itself caused by trade and tariffs, as well as non-tariff barriers, by the way. It's tariff barriers and non-tariff barriers, which obviously matter. That has an impact. The uncertainty in and of itself is also playing a role in relation to the level of risk that we see. So it's trade-related, caused by tariffs and non-tariff fear or expectations, depending on how you look at it. And it's the overall uncertainty about the outcome, which obviously induces different behavior on the part of consumers and investors. Look, on the Genius Act, first point I would make is that having a legal framework is helping understanding what the risks, benefit, and prospects are for these instruments. Number two, I think that it's a little bit early in the process to really have a clear and good understanding of what the consequences will be. Number three, we have to be focused on what we do here at home in Europe. We have to make sure that we are strong in terms of currency, issuance, protection. We are the curator of the euro, and we are ultimately focused on that. So, of course, we are mindful of what's happening elsewhere, what the dangers could be, but we have to make sure that at home we take all the necessary measures to protect and preserve our currency. And in that respect, we are very decisively focused on developing the digital euro and doing everything that we can to be on time and prepared to make this digital form of sovereign money available in the shortest possible time, which doesn't mean that it's going to be tomorrow, rest assured. And cash will always be there, and banks will be part of the game and will be intermediary in the process. But our duty is to make sure that as Europeans' preferences evolve over the course of time, the digital euro is a possible reality. Thank you.
And now Olaf Stolberg of the Financial Times. Olaf, please.
Thanks. I do have two short questions. One is on this interview Isabel Schnabel gave a few weeks ago when she said that the bar for further rate cuts is very high. Do you share that view, or do you have a different view on that? And my second question refers to views expressed by analysts who said that if the trade tensions will be resolved quickly, the question could relatively soon become when the next rate hike will happen rather than the next rate cut in the euro area. Do you think that's a relevant framework at the moment, or is this not relevant from your point of view? Thanks.
Well, thank you for your two questions. You know, each and every executive board members and each and every governor has their preference and their views. And I think it is the beauty of this institution to allow for diversity of viewpoints and for allowing the expression of those viewpoints. Now, my job as president of the ECB is to harness all the views of the governing council members and on the basis of our staff work, projections, proposals to elicit as large a majority view as is possible. That's my job, okay? So what I can tell you as far as today is concerned is that the decision to keep interest rates unchanged was a unanimous decision. I can also tell you that the risk assessment, which is nicely spelled out in the monetary policy statement, was broadly shared by members of the Governing Council. Now, as to future path, I think it's also widely shared by members of the Governing Council that we have to work on the basis of the data as they come in, that we have to decide meeting by meeting, and that to predetermine a path or preset the level or the material and significant development that would trigger one thing or the other is prospective and not part of the job that I do. Okay? I think my response is clear enough. Look, if trade tensions are resolved in short order, it will clear some of the uncertainty that we have weighing on the decision-making of consumers, of investors, of enterprises, and it will, of course, help us as well anticipate and model what the outcome of those tariffs will be. Could it lead to different movements? Future will tell. Our work will tell. I would not exclude anything, for sure. Thank you.
Next question goes to Santi Pignol of Market News International, MNI. Santi, please.
Thank you. Good afternoon, Madame Lagarde. My question is, we are now less than a year from the time when reserves are expected to slip from excess to ample. My question is, are you happy that banks are in a position to deal with the reduced reserve? And is the ECB happy that all the tools are in place for any early signs to stress in the interbank market? Thank you.
Yeah, I suppose you're talking about liquidity and the volume of liquidity. Yeah. Well, first of all, there is still plenty of liquidity in the system. The volume has reduced over the course of time, and it has reduced as a result of the reimbursement of TLTRO, which is now completed. It has reduced as a result of the discontinuation of reinvestment under the APT first and under the PEP second. But despite that, and the fact that our balance sheet reduces on a monthly basis, regularly, predictably, the volume of liquidity in the system is still north of 2 trillion euros. So to talk about limited liquidity in the system, I think is not the appropriate characterization. There is still plenty of liquidity. Added to which, there is probably more liquidity in the system than we had anticipated, because there has been less demand for banknotes, and that has an impact. And there are other technical reasons caused by the fact that governments eventually moved their own reserves away from the central bank to put them to better use somewhere else, which has, as a result, increased the volume of liquidity out there. But liquidity abound. Thank you.
Next question goes to Carlo Boffa of Politico. Carlo, please.
Hello, good afternoon. Thank you very much for taking my questions. I've got two. First one, the EPP lawmaker Fernando Navarrete, the parliament point man for the digital euro, told Politico in an interview this week that the digital euro is a nuclear threat to force banks to act. Do you agree with the statement? And the second one is on the strategy review. Some analysts say that the bar for QE is now higher. Do you agree with this? And do you think it will have any influence on next year's assessment of the operational framework? Thank you.
You know, thank you for your very prospective question. The latter one I'm not going to address, actually, because you are jumping ahead. We have a review of the operational framework that will come in due course in 2026. So we'll take those matters as they come. The operational framework has been approved a few months ago. Let us just see how things work, draw conclusions from that, and then we shall see when we reassess in due course and in due time, that is in 2026. Now, on your first question, you know, I have a pretty simple understanding of what the digital euro is. And for me, this is the digital expression of cash, right? I mean, we all have cash. Well, most of you, I suppose. I do. I like cash, whether it takes the form of coins or banknotes. This is cash, and this is central bank money, if you will. It's sovereign money. But as technologies evolve over the course of time, and as the preference for payment evolves as a result, we need to respond to the demand of our European compatriots. And I see digital euro as the digital expression of cash. It's like digital cash. You can argue at the margin that in terms of, absolute privacy, we're not exactly on the same page. You could argue that the cost of cash is higher, blah, blah, blah. But in essence, that's what it is. So to argue that digital cash is a nuclear bomb, I think that's a little bit over the top. We're not holding nuclear bombs in our pockets, as far as I know. Thank you.
And the last question today goes to Mario Savova of the Bulgarian news agency BTA. Oh, I thought you had raised your hand. Sorry. Okay, well then it goes to Marta Pilar of Econostream, please.
Thank you very much. Good afternoon. Thank you for taking my question. Madame Lagarde, what do you think of market expectations calling for another cut, independent of when it is, especially given that the June projections already incorporate one more cut? Thank you very much.
Well, thank you so much for your question. Markets do what they have to do, and we do what we have to do, right? So what I said earlier is still valid. We are in a good place. We are well positioned to deal with turbulent waters and to deal with the risks that will develop over the course of the next few months. And I'm here referring particularly, but not only, to the risk related to tariffs. But you can include geopolitical risks as well. You can include a vast uncertainty, which might partly clear as a result of whatever tariff certainty we receive. So we are well positioned. We are in a good place. We have essentially closed that disinflationary cycle that we battled over the last months and which has led us to move from 400 basis points to 200 basis points with 8 cuts in a matter of 9 months. So we are in a good place now to hold and to watch how these risks develop over the course of the next few months. And we will have a new projection in September, and later on, we reassess at each monetary policy meetings. We do projections and we publish them on a quarterly basis, but we do that on a regular basis, and we will continue to do that in September, in October, in December, and on and on. And it's on the basis of that work that the Governing Council will decide what is the appropriate monetary policy stance. So I cannot tell you much more than that because it's been repeated twice in the monetary policy statement. I've tried to avoid repeating it too much, but our collective determination is, number one, keep inflation at 2% medium-term target. Number two, operate on a meeting-by-meeting basis. Number three, be data-dependent, and there will be plenty of that in the coming months. And not have any kind of predetermined rate path. Some people would like it. I understand that markets would like to have, more anticipation of that possible rate path. No, that is not possible under the current circumstances. But, as I said, we are well positioned to wait and see. And with that, I wish you all a nice wait-and-see holiday. And I hope that you take time to rest, enjoy family moments, friend moments, and have a good time in this uncertain world. Thank you so much.
And we will be back on 11th of September, if you want.
the so-called Gaza, quote, Gaza Humanitarian Foundation. A joke, inhumane.